Good afternoon, welcome everybody. Welcome to Shifting to Digital Tax Compliance. My name is Will Craven. I'm the Regional VP for Northern Europe at Tradeshift, and joining me today, I have Christian van der Valk, who is VP in Strategy for Regulatory at SOVOS, joined by Jean-Cyril Choutelet, who's Director of Product Management when it comes to continuous transaction controls, also at SOVOS. The purpose of today is we're going to be running through some of the mega trends that came out in the report that was published recently by SOVOS, and then I'll be tacking in on the end with how this relates to the application of when it comes to e-invoicing, particularly for Tradeshift customers. So with that, I'm going to hand over to Christian. Christian, are you there?
Will, shall I take over from here?
Yes, please.
I'm sorry. Okay, sorry. So, hey, everyone, this is Christian. Thanks, Will, for the introduction. I'm just going to talk for a few seconds about SOVOS. Obviously, I'm assuming many of the people who have joined this webinar are very familiar with Tradeshift. SOVOS is a global company in the tax technology space. Funny enough, we might not be that well known in Europe under this name, but SOVOS has been around for some 4 decades already as a leader in the tax technology space, initially in North America, and nowadays with solutions for many countries around the world, and quickly expanding. What makes SOVOS different from other tax technology leaders globally is that SOVOS has started investing in what we've started calling the continuous transaction controls segment of the compliance market much earlier than many others, and therefore that has given us a position whereby SOVOS can provide services across this converging space of indirect tax or consumption tax compliance and its digitization. If you could advance the slide for me, please, just once. What that means is that we provide services in a number of categories of compliance requirements, all the way from, I would say, traditional periodic reporting for indirect taxes, VAT, sales and use tax, and others like GST in many countries, but also continuous reporting, such as My Data in Greece, RTIR in Hungary, and other digitized reporting schemes. Moving to continuous transaction controls, electronic invoicing in different shapes and forms, including post-audit electronic invoicing, which is the kind of the version of electronic invoicing, often voluntary, that is still applicable in many countries. And then finally, SOVOS is a leader in tax determination generally. But not to talk about SOVOS, that's not why we're here. I will present 4 megatrends in tax digitization that we are identifying in our report, and that together with our colleagues from Tradeshift here, we'll be talking about in more detail. This picture kind of summarizes the 4 trends: CTCs, a focus on aggregators, e-accounting, and destination taxability. But what this slide also tries to say is, from a company perspective, those slides need to fit into a solution strategy, a process and organizational approach to these trends that tie together e-invoicing, e-reporting, determination into both your transactional environments and your records and your data, which is really where the big challenges for many companies are. So let's go and look at the individual trends, starting with, if you could advance the slide just once, what we view as probably the sort of umbrella trend here, which is happening around the world in many countries, but it started in Latin America. And essentially, the best way to think about continuous transaction controls, which of course in many countries is still sort of mostly referred to as electronic invoicing, is as a continuum from the left-hand side of this picture here, which is really just, you know, good old VAT returns, to a more transactional way, a more granular and more frequent way, using electronic data for tax administrations to get their hands on day-to-day transactions from businesses and ultimately also with consumers. Many countries around the world are still requiring businesses to file VAT returns, but starting in the early 2000s in countries like Chile and other countries in Latin America, following that, tax administrations have really created this revolution around the transactional enforcement of VAT. In the meantime, that has become a huge global trend. Not all countries in the world are flipping a switch like Latin America did from from paper forms to real-time clearance of electronic invoicing. Invoices, many countries are taking it a little bit more slowly. The diversity and also the fact that this journey to continuous transaction controls moves through different phases in many countries is what creates a lot of challenges at the moment for businesses, particularly multinational businesses. But ultimately, the end of this journey, and Chile is a very good example of that, because actually it was the country that started the first with continuous transaction controls. At the end of this journey, it is no longer the business that files the report on transactions. It's actually the tax administration that uses transactions harvested during the actual transaction process, and in many cases pre-approved by the tax administration, to send the business the return at the end of the month, right? So it's a complete reversal of what we have known for many, many decades as VAT compliance. It's now all about authenticated transactions and the tax administration pre-filling the return. If we could flip one slide. Now, when we talk about continuous transaction controls and e-invoicing, and of course, understanding the why is often very important to know what to do or how to respond. It's important to realize that yes, tax administrations are behind this in order to close VAT gaps. The improvement in VAT collection, tax collection generally, is without a doubt, one of the biggest reasons for tax administrations to go down this path. It's not the only one, though, and I think what we're looking at here is a very good example of how a country like Brazil, that is very advanced in this area, has been able to take this real-time authenticated data from businesses during the COVID period and published very, very granular details on how every segment of the economy, every subsegment was affected in real time. And of course, that gave the Brazilian administration fantastic opportunities to intervene and support those sectors that suffered the most. So real-time data is probably in the long term for the government an even bigger benefit of CTCs than just the fiscal benefits by themselves. We could slap on one slide now, but what does e-invoicing or continuous transaction controls at its core actually mean in terms of the business process? How does it change what we have always looked at as VAT compliance? Instead of filing a report at the end of the month, as I said, it's all about the live transaction. And on the highest level, just schematically, what it means is the basic template that was invented in Latin America is that the supplier needs to issue an invoice in a structured format prescribed by the tax administration in the syntax with the content prescribed by the tax administration, send that to the tax administration, usually with a digital signature, usually focused on authentication by the tax administration to make sure that there is no repudiation in that channel. The tax administration reviewing that invoice and then returning an okay or not okay in the form of some kind of digital token, either an okay in an electronic signature form or another way that can indicate to the supplier whether or not they are then allowed to issue the invoice. Only then can the supplier send the invoice to the buyer, and the buyer in many cases needs to go back to the tax administration and go through the same routine of checking the validity of that invoice. With the information from both the supplier and the buyer, the tax administration can do a lot in terms of controlling the VAT inputs and outputs in the system. If you could advance the slide just once more now. That original kind of clearance model that I just talked about is still dominant in Latin America. But we've started to see different flavors of continuous transaction controls emerge in different regions. On the highest level, this spider diagram is maybe a good way of looking at it. Latin America or South America still very much dominated by clearance of electronic invoices, but also forms of continuous reporting for closing the loop on indirect taxes, but also direct taxes in certain cases. Europe, however, while it has been and is increasingly inspired by Latin America, and as we probably all know, the European Commission is taking a very lively interest in the future of digital VAT, electronic invoicing, and such methods right now in its policymaking. Europe is likely and going to be influenced by two additional sort of components. One of them is the continuous reporting, because reporting is much more advanced in Europe in many ways, and we've got things like SAFTI that I will talk about, but also the public procurement world that has been very influential in helping standardize electronic invoice transactions for public procurement, for B2G invoicing, and that is influencing the B2B environment as well. In Asia, it's a little bit different. We're seeing, as you move towards the east, two additional trends or tendencies. One of them is in certain countries that are influenced by the common law culture, and I'm just going to say countries like, for instance, Singapore, Australia, New Zealand, to some extent perhaps Japan and Hong Kong, are more interested in opening up the economy to the benefits of e-invoicing. Less so in necessarily immediately reaping the benefits from a fiscal perspective. So creating national e-invoicing frameworks, often actually inspired by public procurement standards. But other countries in Asia are taking all of this quite a few steps further, looking more at being the interchange model, the interchange platform between suppliers and buyers for the whole of the economy. So being the central monopolistic EDI forum, if you will, for all countries in the economy. In North America, of course, there is no VAT, but there is a sales and use tax. Business-to-business invoices don't play the same role, but there is also a tendency towards, as some of you might know, active live exchange of electronic invoices for economic purposes, and also for benefiting the purchase by the public. If we could move one slide up. I'm going to talk through this slide relatively quickly. You are seeing these different models, and I just wanted to show them schematically. The first model that we're seeing in electronic invoicing is kind of the classic LATAM model that I talked about earlier. And what you should note here is that the exchange of the invoice between the supplier and the buyer is actually not regulated. It's all about regulating a standardized interface between the taxpayer and the tax administration. This means that you get very advanced exchange between those two parties for fiscal purposes, but actually don't get a lot of standardization between parties in the business-to-business chain. That is one of the criticisms of the models that we've seen in Latin America over the last decade or two. If you could click once more, please. Then you've got this model that is more inspired by things like PEPL and public procurement, and people who are saying, hey, let's build the network first, which we look at a little bit as an enlightened model, whereby the regulation tries to first encourage or push businesses to go down a standardized e-invoicing route, use automation between suppliers and buyers to get the economic benefits of that, and then add layer into that the CTC and fiscal approvals that you can get on top of the standardized exchange of invoices. If you could click once more. Now, we've got this other model that we've called Own the Network. And I talked about, if you move east, you see more countries interested in that, which is quite a drastic way of looking at monopolizing the exchange of electronic data between businesses. But it isn't just countries in Asia. Actually, Italy, the first CTC country in Europe, uses that model as well, whereby, shockingly for some of us, the actual interchange between businesses isn't done anymore by private, by software or private service providers, but is done by a government fiscal platform for the whole of the economy. That has certain benefits in getting very quick adoption of e-invoicing, particularly for SMEs. Of course, you can ask yourself if that in the long run will actually benefit the economy. If you could click once more, the final model that we're seeing, and I think France is an excellent example of this, and Jean-Cyril will talk about that a little bit more, is experimentation with different hybrids of the models that we've seen in the previous three pictures, whereby there is both a centralized exchange potentially just for small and medium-sized companies, but also the opportunity for businesses to freely exchange invoices and just report to the tax administration. So more about that in just a minute. If you could click once more now, in the report, if you've downloaded a copy from the Tradeshift website, you will see that we are doing quite a bit of analysis in how the rollout of CTC schemes typically works chronologically. Most of these CTC mandates are not introduced in one go, but little by little, with different functionality getting added by the legislator over a period of usually 5 to 10 years or so, affecting more and more parts of the order to cash or purchase to pay cycle. And this is important to note because companies that think that with the initial introduction of a mandate that is focused on just the issuing of invoices, that kind of closes that chapter. I think you'll be sorely disappointed. It's good to prepare for much broader mandates, because what we've seen in Latin America and we're seeing in other regions where CTCs are more mature is that there is a long period during which additional functionality gets added to these schemes, affecting more and more individual business processes and ultimately covering a lot more ground than just the invoice as a document as well. You could click once more. Yeah, so importantly, one of the things that we have started noticing in the last couple of years is that among those additional documents, a transport document is becoming very popular as an additional data set from the chain of commercial documentation that tax administrations are very, very interested in. And in so doing, of course, what they're trying to do is further close the control loop so that it isn't just the physical, the financial supply chain whereby the invoice plays a role, but also the actual physical supply chain gets controllable from the invoicing process using electronic data interchange with the government. The next slide kind of looks at a little bit more detail around that. I'm not going to go into all of this detail, but you can see here a set of examples of countries that have already introduced different types of electronic transport documents for fiscal control purposes on top of CTC schemes, with both quite a bit of similarity, but just like with the invoicing mandates, also a tremendous amount of variation in terms of how these schemes work and how law enforcement on the ground can control goods in movement on a truck, on a train, or in flight, so that the invoice information can be cross-referenced to what's actually being transported using QR codes or other types of tools that individual law enforcement officers can handle. If you could click once more. The second trend, so we've talked a lot about CTCs here. I'll fly through the other trends to make sure we can spend more time on some of the individual country examples. Second trend is at this moment more visible in the world of electronic commerce. So the sales cross-border, particularly of digital services or low-value goods. However, we are seeing this destination principle, or the idea of destination taxability, more in other areas of B2B in value-added tax as well. And the idea with all of this is that increasingly countries want to control from a VAT perspective what gets consumed, purchased in their country, which for a number of sectors, particularly around e-commerce and digital services, has not historically been the case. And of course, the probably best example, if you could click once more, please, of that happening is the changes that came into effect earlier in the mid last year in the European Union around the e-commerce package, where this idea of destination taxability is one of the key motivators and the key vehicles for the European Union member states to charge VAT on low-value goods and digital services where they previously did not. One more click. The third trend is a little bit related to electronic commerce, but it's also broader than that. And we are highlighting it because we believe that this will become a stronger trend over time. What we mean by that is that the tax administrations, as they receive more and more transactions in real time from B2B, B2G, and B2C transactions, will be under an obligation to process so much information that logically they will be looking for existing aggregators in the economy to help with the processing of that information, but also to help making sure that the liability and just the possibility of enforcement becomes a little easier. So e-commerce marketplaces are the first and most known examples of that. Instead of going after a few 100,000 individual e-commerce vendors, you can use the law to put a lot of liability on the e-commerce marketplace that is selling in your jurisdiction. Payment service providers, for those who are familiar with the directives in the European Union, of course, are already in the hook for providing credit card payment information to be triangulated with that kind of reporting for e-commerce marketplaces as well. But increasingly, we're seeing express carriers, B2B networks, and even multinational companies themselves as potential aggregators that tax administrations can use for efficiency purposes as they move towards digitized enforcement of value-added tax. The last trend is kind of a wrapper in many ways around the other trends that I just discussed. It's the logical conclusion that I started with when I started talking about CTCs earlier. When you look at CTCs, the emphasis of the enforcement will be on the transaction. You have to send the data, in many cases, even before you issue the invoice to the tax administration. And what that means, as I mentioned, is that the tax administration ultimately will be using that authenticated data to then send the business the tax return, as opposed to how that used to work in the past. Now, e-accounting is kind of the next step from there, because tax administrations are, of course, not only interested in consumption taxes like VAT and transaction data, also interested in the actual accounting treatment of the transaction data, as well as a lot of other information that might be sitting in different accounting system or ERP ledgers that are all necessary for tax administrations to account for tax and make sure that not just VAT, but also direct taxes like corporate income tax can be digitized, and where enforcement can be leveraging different digital tools. E-accounting is an important aspect of that, because it is all about the standardized interchange of a very broad set of accounting data to the tax administration, usually on demand, but increasingly also as a report in different shapes and forms that need to be pushed to the tax administration. And the best known example of e-accounting in our view is this thing called SAFT, which stands for Standard Audit File for Tax. It's a norm or a standard devised by the OECD, which tax administrations can use in very flexible ways to require businesses to give them a tremendous amount of transaction information, accounting information from the ERP systems in a standardized and easily auditable manner. So this can go from what we've seen, for instance, in Poland, using the SAFT standard to structure a supplement to the tax return with more transactional data, to really in certain countries like Norway and others with a much broader set of ledger information that businesses either on demand or as a report need to provide to the tax administration from their systems. Also staying with SAFT, as I said, e-accounting is the broader trend, but SAFT is the best current example of that. We are seeing a renewed interest in SAFT as a complement to continuous transaction controls and the other trends that I talked about. But also here, because this is just inherent in the way that legislation and technology get introduced, there's a tremendous amount of variation. The fact that the SAFT standard, as it has been designed, provides flexibility is great for countries because it's a flexible instrument. It's not so good for multinational companies because there is a lot of difference in terms of content and form and timing and process aspects of how these SAFT forms files need to be provided to the tax administration. So that closes trend number 4. And with that, I'm happy to hand over to Jean-Cyril to talk more about the practical aspects of CDC.
Thank you, Christian. Yes, so we are now going to give a look at what you and your company should prepare for in the coming months. As Christian just explained, many countries throughout the world have already put in place a CTC scheme in some shape or form. And it all started with Latin America 15 years ago. And it has since been expanding to other continents. Excuse me. Among the early adopters, following the steps of Latin American countries, you find countries like Italy, Spain, Hungary, Turkey, India, South Korea, which have all put in place some kind of CTC scheme, although they have not always mandated e-invoicing. And today, the CTC momentum is really growing bigger. If we if we look at the map here, we display two types of countries which are going to shift to a CTC scheme in the very near future. There are those flagged as planned, which have announced their intention to adopt a CTC regime without necessarily being very detailed as to how this would work, or which haven't yet defined accurate deadlines. This is the case for Belgium, Slovenia, Bulgaria, Israel, or China. Although one might argue that for China, there is already a kind of CTC scheme with the golden tax system, but since the tax administration there is currently experimenting with a completely new system with mandatory invoicing, it is expected that companies will have to cope with major changes there anyway. The other category, flagged as specified, contains countries which have set up a deadline and have already released fairly detailed specifications regarding how their CTC scheme will work. This is the case for France, Poland, Romania, Slovakia, Serbia, Saudi Arabia, the Philippines, or Vietnam. So this is quite a bunch, and this list is getting longer with countries like Germany, for instance, where we know that CTC is on the top of a new government political, the new government political agenda. And the time, if we look at the time remaining for companies to prepare themselves, one realizes that it's quite short. If you exclude France, which targets July 24 as its deadline, in most countries, companies will have to comply with those CTC requirements within the next year or so. The trajectory to the obligation varies per country, though. As you can see, some countries like Romania, Poland, Saudi Arabia, and the Philippines have anticipated that companies would need time to move up the learning curve, and they have therefore implemented either voluntary adoption phases or simplified the initial requirements that taxpayers need to comply with. For instance, Romania and Poland have started their voluntary phases respectively last November and in January. Saudi Arabia, since last December, is just requiring that invoices be created and issued in an electronic structured format and archived on their territory. Beyond those initial phases, the CTC rollout plan is usually staged in several stages, starting with the largest companies or some priority industries. For instance, Romania will start mandating the system first for suppliers trading in so-called high-risk products this July, and then we'll generalize it to all taxpayers, probably in January 23. The Philippines are also limiting the initial phase to 100 large taxpayers starting in July, with a potential generalization also in January 23. And at the same date, so January 23, Saudi Arabia will start moving towards a full CTC scheme, requiring that B2B invoices be cleared in a specific structured format by the tax authority platform before being electronically sent to the buyers. And although we don't have the details yet, it is expected that this obligation will also be staged with larger taxpayers being mandated first. There are exceptions, though, to this staging approach, with some countries such as Vietnam, and as far as we know, Slovakia as well. They will require that all their companies jump into the CTC pool at the same date without a preliminary voluntary phase. So to sum up, there is not so much time to comply, especially if you're not taking the voluntary phase period as an opportunity to get ready. So the obvious question now becomes, how difficult is it to comply? And that's on the next slide. You will see that, in fact, complying with CTC requirements is a heavier lift than for post-audit countries. The reason why is because in the CTC realm, post-audit requirements usually remain relevant and are compounded with additional constraints. So you usually still have to demonstrate the invoice authenticity and integrity using, for instance, the appropriate digital signature certificate. You must still ensure the document's legibility by producing a human readable format when required. And you must still archive the invoices during the legal duration, sometimes taking into account some localization requirements. But on top of that, when you move to CTCs, you need to put in place the right connections with the tax authority platforms and with the other trading parties that can be directly or through a service provider. And you need also to map your data into legally required formats. Additionally, you must also apply some specific controls or processes like checking mandatory fields, adding security features like hashes or QR codes. And you also need sometimes to integrate a clearance status that the tax authority platform might be sending you back, so you can later demonstrate that the invoice was indeed cleared. There's also sometimes a certification process which is required, as will be the case in France, or you need to use an accredited local service provider, as is the case in Vietnam, to demonstrate your ability to meet operational and security standards. And all of this must be tackled in a context where it is not rare that the official documentation is not clear or detailed enough, and therefore requires, complementary direct Q&A sessions with tax authorities, or testing extensively the public platform to better understand, if not reverse engineer, in fact, the processes. I'm going to go very fast on the next three slides, but they are kind of illustrating, the different type of requirements you may meet depending on the countries. Here it is Poland, the requirements overview, and as you can see, the scope is very large. It includes VAT registered but non-established company. So it's very large. It is an invoicing mandate with a clearance mechanism, meaning that supplier must obtain an authorization from the TA platform before they send their invoices to their customers. The invoice must meet a specific XML format, and there's a number of process requirements, such as authenticating on the TA platform, tax authority platform, sorry, using a supplier-specific qualified signature. If we move to the next slide and we look at Philippines now, you'll see that it's somehow simpler. The scope is limited to companies exporting goods and services, e-commerce companies, and companies considered as large taxpayers, at least for now. It is an e-reporting scheme and not an invoicing one, meaning that invoices can still be issued on paper, but their content needs to be reported to the tax authority platform within the next 24 hours. And the process is more straightforward than for Poland. Basically, you need to map data to a JSON file format and apply a digital signature, and that process can be delegated to a third party, such as SOVOS. If we move on to the next slides, this is the France example. And here, you realize that it's yet another completely different game with not only a very large scope in terms of transactions. If you move forward in the slides, you'll see that, but also requirements that data be reported that goes beyond sales invoicing data, strictly speaking, such as the invoice lifecycle statuses in the case of domestic B2B invoicing, purchasing data when suppliers are not French, and payment data in the case of service transactions. And you have to do this either connected directly to the tax authority platform or through a certified so-called partner digitization platform. So 3 countries, as you've seen, and 3 scopes and 3 completely different processes and process requirements, and yet they're all CTCs. If we look and go on the next slide at our coverage and map and roadmap, really, SOVOS provides software solutions embedded within Tradeshift all over the world, and which allows your companies to comply. Our motto at SOVOS is solving tax for good, but it might as well be protecting your peace of mind or the quality of your sleep for good, since we hide all this tax and legal complexity from you, and we just apply the right processes depending on the type of transactions you are sending us through Tradeshift, whether as an issuer or as a recipient of the invoice. So as you can see on this map, we cover LATAM, but we'll also cover countries like Italy, Turkey, India, South Korea, which have already implemented CTCs. We are developing solutions for countries which are now adopting CTCs that you can see in orange on the map. We are monitoring closely the situation in countries which are planning to implement CTC soon, like Belgium, Bulgaria, Israel, or China. And all of this, of course, come on top of our solutions for countries where post-audit invoicing is still applicable. And we ensure your business stays compliant at all times. We have a team of 100 experts who continuously monitor, interpret, and codify changes into our software. So the compliance burden on your tax and IT teams is reduced. If we move on to the next slide, we'll see that we cover LATAM. It's a way to illustrate what Christian said a little bit earlier, where the more mature a CTC scheme is, the larger the scope and the type of transactions it regulates. And this long track record in covering and complying or helping companies comply in those countries is really what makes SOVOS unrivaled on the CTC compliance market. So last slide. How does it work from an architectural point of view? I'll be short, but this is actually quite simple. We are connected through with the Tradeshift platform through what we call the Connect Once API. So it's basically a communication channel relying on a standard invoicing data format called the SOVOS Canonical Invoice Format, or SCI for short. And every inbound or outbound message which needs to go through a compliance process is forwarded by Tradeshift through this API in this SCI format. The API calls specify what type of compliance service is to be applied for which country. For instance, clearance in India, or post-audit in the Netherlands, or e-archiving in France, or a combination of several services. We execute this request at SOVOS and send back the output data to Tradeshift through the same channel, so they can push it back to you. And the benefit of this Connect Once API is that you don't need to reinvent the wheel every time you want to add a new country. You just have to adjust your invoicing data payload. In some case, you may need some specific new fields because they are specifically required for a new country, but this is a marginal effort. All the heavy lifting has been done upfront when you connected with Tradeshift and indirectly aligned with the Connect Once API requirements and formats. Thank you.
Thanks, JC. And just really to cap off on that, if anyone's wondering why the partnership between SOVOS and Tradeshift, well, it's come out of necessity, right? So over the last 10 years, we have been working very hard on building our single global network, which was originally came from the team that designed NameHandle, which then became Peppol. But we set out with the intention of building a single global network that would enable digital global trade, right? And that's a bold claim. And if you're going to go that kind of wide and deep and work with the biggest, most complex organizations on the planet who are operating in multiple countries, they've got entities accruing revenue in different tax regimes with very long supply chains, if you're going to service and support them, then you equally have to have the breadth and depth of coverage, which is why we partner with SOVOS. It's no good saying we enable global trade if we can only support customers in a handful of countries, okay? And what I just want to highlight also is that whilst Tradeshift has a number of functional pillars on the network spanning from left to right, procurement, payables, supplier onboarding, receivables financing, and virtual card spend, everything that we're covering today is kind of tied into the integration between SOVOS and our invoicing platform, the pay solution. So when it comes to AP, so obviously we have SOVOS from a tax compliance, but from a Tradeshift point of view, we've got really two challenges we need to address for our customers. One, we've got the e-invoicing regulations and compliance, which focuses on the 4 requirements you can see there around authenticity, integrity, readability, and storage. But equally, we've also got the other side of the coin, which is the tax compliance. And therein, how do we give customers a single solution to operate in both post-audit and clearance countries, managing both e-invoicing and tax compliance on a single instance of a network? And you've got to do all of that at scale with all of the regional variances that Christian and JC have just highlighted and the complexities therein. And our approach is built on this kind of, it's like think of it as layers, like a tiramisu for compliance, that we have at the most fundamental level, this connection model, much like LinkedIn. You only accept the people that you want to do business with. And so through the connection model, we can ensure that buyers are working with suppliers that meet both their corporate and compliance requirements. We enhance this with workflow and matching, which you'd argue is probably more for e-invoicing compliance, but does add incremental validation. And then on the left-hand side of the screen, we have the document validation, which we do through something called our business firewall. And this is where we enable companies to maintain and control those country-specific checklists and validation rules that JC has just covered off on a country-by-country basis, and that are fundamental to being able to process a document end-to-end. What this means to me when it comes to the application from working in clearance countries is that in order to attain and then maintain compliance, we rely first on, fundamentally, we've got to have an updated and thorough knowledge base, right? Which is where our partnership with SOVOS comes in. And through the updates we get from SOVOS, through the Connect Once API that JC mentioned, we can then leverage it via two very key elements in managing clearance for both inbound and outbound. First of all is the business firewall, so this pre-dispatch validation. And at its core, the business firewall is there to ensure that sellers submitting documents to buyers are meeting the rules and procedures needed to process those documents. These validation checks are there to ensure that we reduce the amount of exceptions and manual intervention. But the same principles apply when we're submitting in accordance with whatever the clearance requirements are, right? There are profiles which are very specific to countries that need to be applied on a country-by-country basis, and they could be specific fields or validation of tax identifiers, listed default taxes, and so on. But they do vary greatly, and they are incredibly complex. So from a customer perspective, I think the key takeaway from this is that Tradeshift and SOVOS are doing the heavy lifting, and the enablement of the country-by-country compliance, when we do it through the business firewall, is a simple kind of true-false setting. After that, we get on with the heavy lifting and managing the complexity and the risk around the tax and compliance, and customers can get on with managing their business. And I think that's something that customers may sometimes lose sight of, that you are connecting to a service, leave the heavy lifting to us, and then we will manage that risk and complexity for you. And then lastly, as JC's already highlighted, and as I mentioned before, if you're going to provide a network for global trade, you've got to be in as many countries as possible. And at the moment, we have buyers and sellers in just about every country in the world, barring, of course, sanctioned and embargoed countries operating in multiple languages. And with that, we are coming up on time. So I would like to thank you all very much for attending today, and wish you all a good afternoon.